Welcome to Talk Tickers, where we cut through the noise of the financial world.
And give you the knowledge you really need.
Today we are doing a deep dive into a true titan, Goldman Sachs. We're unpacking their fourth quarter 2025 earnings call, which just dropped on January 15th.
And the numbers came out before the market opened.
They did, and the reaction was, let's just say it was not subtle. The stock just exploded, vaulting over 4.5% almost instantly.
Right. It was like the market read the first page of the script and knew exactly how the story ended.
A decisive win. And it seems to be all about a return to their core strengths. So our mission today is to really get under the hood here.
To understand the machinery, right? The strategy, the market forces, even some of the regulatory stuff that fueled this big move.
Exactly. And what it all signals for 2026 and beyond.
Well, if you look at the last few years, it's clear management has been laser focused.
On simplification.
Yes, on simplifying the business, getting rid of those legacy issues, and just leaning hard into what they've always done best, their institutional dominance.
So this quarter wasn't just a good quarter because the market was up.
No, not at all. This was, I think, confirmation that the pivot is really paying off. The quality here suggests they're building real systemic resilience back into the business model.
Okay, so let's get into the numbers, the results snapshot, because the sheer size of the beat really sets the tone for everything else.
It really does.
We saw just powerful performance across the board. The bottom line, GAAP earnings per share came in at $14.01.
Which is just a blockbuster number. I mean, to put that in perspective, Wall Street was looking for something like $11.67.
$2.34. When you beat estimates by almost 20%, you're going to grab the market's attention immediately.
And the top line, the revenue, was just as strong, $13.45 billion.
Yep, surpassing the $12.96 billion consensus. But the real headline there
is the year-over-year growth.
Exactly. That's a 23% increase compared to the same quarter last year.
Yeah.
Just a massive number. Net earnings were right there with it, up a solid 12% year over year to $4.62 billion.
But, beyond the raw numbers, I think the most important signal, the forward-looking one, was about capital.
The dividend hike.
The dividend hike. They raised the quarterly dividend to $4.50 per share.
And a move like that tells you what?
It tells you two things. First, they are incredibly confident that these earnings are sustainable. And second, they believe the regulatory picture is finally firming up enough to allow for that kind of capital return.
Absolutely. A dividend hike of that size is a statement. But the key, like you said, is that this wasn't just one lucky break in one division.
No, this confirms the back to basics thing is working. The strength came from both sides of the house, the transaction businesses, and that durable fee income.
The core franchises fired together.
Precisely. So let's start with global banking and markets, or GBM. That's the transaction engine. That's where they make money when there's volatility and deals are happening.
And it looks like the sun was definitely shining on the equities desks.
A record performance. Just incredible. Net revenues in equities had $4.31 billion.
Up a full 25% year over year. I mean, that's a staggering growth rate for a business that big.
It is. And the detail they gave is really interesting. Within that, the equities financing business alone was up 42%.
42.
A quarterly record of $2.1 billion. And they said that was all due to record average prime balances.
Okay, so let's pause there. For anyone who's not deep in banking terminology, what exactly are prime balances and why is it so important that they're at a record high?
Sure. Think of prime brokerage as the high-end concierge service for big hedge funds and institutional clients. The prime balances are the assets those clients keep with Goldman.
Their cash, the securities they borrow.
Exactly. So record balances mean Goldman is just deepening its relationship with its most important clients. It means more lending, more services. It shows the whole franchise is getting stickier.
So that's not just a lucky trading quarter. It's about structural strength in their relationships.
That's it exactly.
Makes perfect sense. And beyond equities, their FICC trading fixed income, currency, and commodities also had a solid quarter.
Very solid. $3.1 billion, up 12.5%, mostly driven by rates and commodities. So the whole trading side was firing on all cylinders.
But the part that gives investors confidence looking out into 2026 has to be the investment banking division.
Without a doubt. Advisory fees were up 25% to $2.58 billion. And management sounded very, very confident about the pipeline.
Right. They talked about a constructive IPO pipeline for 2026, strong M&A engagement. I think they cited advising on 1.48 trillion of deals in 2025 alone.
But here's the number. Here's the clearest signal of momentum. The investment banking backlog. It rose for the 7th straight quarter.
7th. That's an incredible streak. It's now at a 4-year high.
It is, and they were clear that the strength is coming from that high-margin advisory work, which is critical because that work acts like a multiplier for the whole firm.
Right, you advise on a huge deal.
And that same client suddenly needs financing, currency hedging, asset management. The whole ecosystem kicks in. It's a flywheel.
That M&A pipeline sounds great, but we've seen backlogs like that just evaporate when market confidence disappears. Is there any reason to think this one is stickier?
That's a fair question, and you always have to be skeptical. But the evidence suggests it is stickier this time. A lot of these are big, complex, strategic deals.
Not just small opportunistic trades.
No. And you also have this massive amount of what they call dry powder.
Capital sitting on the sidelines in private equity.
Trillions of it, just waiting to be deployed. That creates constant pressure for M&A to happen. And Goldman, as the #1 advisor, is just perfectly positioned to capture that when it flows.
Okay, so the transaction engine is roaring. But what happens when things quiet down? That's where the other side of the strategy comes in, right? The asset and wealth management business, AWM.
Exactly. That's the stabilization engine.
Right.
And moving over to that durable side of the business, they delivered record management fees of $3.09 billion.
That's the predictable, recurring revenue that smooths everything out.
And the scale is it's hard to get your head around. They finished the quarter with $3.61 trillion in assets under supervision. That size is its own competitive advantage.
And management is clearly signaling they expect more from this division. They announced a big increase to their pre-tax margin target for AWM.
Right, moving it up to 30% over the medium term. It's at 25% now.
What does a 5-point margin increase signal to you as an investor?
It signals operating leverage. It says they believe they can grow assets and revenue much faster than their costs. It also shows they're having success integrating some of their recent acquisitions.
And they also put out a new target for inflows.
They did. 5% long-term fee-based net inflows annually. That's a clear growth target for their wealth clients.
And they're getting aggressive on alternatives, too, which is where the really high, sticky fees are.
Oh, yeah. They said they intend to raise between $75 and $100 billion a year in alts sustainably. They're building towards a goal of $1 billion in annual incentive fees.
So they're monetizing that institutional access for their high net worth clients.
Exactly.
Now, we can't talk about all this strength without talking about the de-risking. The final retreat from the consumer business.
The trade-off. It's the trade-off they made for more predictable returns and, frankly, less regulatory headache.
And the big news was the agreement to transition the Apple Card portfolio.
Which follows the GM card transition earlier. And this had a really interesting financial detail attached to it. A net positive impact of 46 cents to EPS.
Okay, so that 46 cents, we need to look at that carefully. Was that a real operational win, or was it more of an accounting benefit from cleaning up the books?
It's a great question, and the answer is it's a bit of both. The positive impact was mostly from a $2.5 billion reserve release.
So once they decided they weren't holding the risk anymore, they didn't need to hold the capital against potential losses.
Exactly. It's a one-time benefit from ending the experiment. It's not core operating strength. But they were very careful to clarify one thing.
The Apple Savings Program.
Right. There is no agreement to transition that. That savings business is a source of low-cost deposits, which is incredibly valuable.
So they're getting out of the complex lending risk, but keeping the simple strategic deposit relationship.
That's the message.
So if you're an investor, you're looking at record trading, a surging M&A pipeline, a stronger wealth business, and a successful exit from consumer banking. It all points to execution credibility.
And a structural change in the firm's resilience. I mean, they were asked directly about how they'd perform in a downturn.
And what did they say?
They said they have fundamentally raised the floor on their business. They pointed out that before 2020, their returns were averaging around 9%. Now they expect the GBM franchise alone to run in the mid-teens through a normal cycle.
How can they be so confident about that resilience? What's actually changed?
Well, it comes down to risk and capital. They've managed to reduce their stress capital buffer requirement by 320 basis points since 2020.
The SCB. That's the extra safety cushion regulators make them hold.
Exactly. And a 320 basis point improvement is huge. It frees up billions in capital that was just sitting there for a rainy day. Now they can use it for buybacks, dividends, or growth.
And this is where it gets really interesting, tying back to that bullish market reaction. Someone asked if the record EPS year of 2021 was the ceiling for the firm.
And they pushed back on that hard. They strongly disagreed.
Which is a powerful statement.
It is. They're not just hoping for another record, they see a path. They said the bull case for advisory volumes in 2026 could actually exceed 2021 levels.
And that optimism is anchored in that $1 trillion of private equity dry powder just waiting to come into the market.
Right. Given they're number one in M&A, they're just set up to capture a huge slice of that value when those deals finally happen. It's a perfect storm of opportunity meeting market share.
And to make sure they're as profitable as possible when that volume hits, they announced a new initiative.
One, Goldman Sachs 3.0.
Yeah.
Using advanced tech, LLMs, to re-engineer their processes.
Is this just a fancy way of saying cost cutting?
They're framing it as a productivity play. The goal is to drive efficiency, to free up capital, and people to invest in growth areas, like hiring more wealth advisors.
So using tech to optimize the core to fuel the future.
That's the idea. And on top of that, they pointed to some big regulatory shifts that are turning from headwinds into tailwinds.
Giving them more capital flexibility.
Exactly. 3 specific things. First, that 320 basis point improvement in the stress capital buffer we talked about. Second, the feeling that Basel III implementation will be more neutral than they once feared.
And the third one was about the G-SIB surcharge. That's a term a lot of people might not know.
The G-SIB is the global systemically important bank surcharge. It's basically an extra capital penalty for being one of the biggest, most complex banks in the world.
A penalty for being enormous.
Pretty much. And they're saying that because they've simplified their business by getting out of consumer lending, their score has improved. They need to hold less of that restrictive G-SIB capital. It's a real, tangible tailwind.
And that regulatory relief, that's what gives them the firepower to execute on that remaining $32 billion share repurchase authorization.
It's a huge capital allocation advantage that a lot of their competitors who might be facing tougher requirements just can't match.
So they're shedding risk, reallocating capital to high-return businesses, and getting a boost from regulators. Meanwhile, the biggest risk out there for the whole sector is political.
Right, the threat of credit card interest rate caps, which is a risk that Goldman is very actively and successfully walking away from.
Okay, this is not financial advice, but after a deep dive like this, we have to distill it into a potential setup. The market loves the story, but the stock is already up over 70% in last year.
Which raises the bar. The risk is that the deal pipeline fizzles out or liquidity just dries up.
So it's the trade.
Given all this, the strategic clarity and the regulatory divergence, we're thinking about a pair trade. You go long Goldman Sachs, GS, betting on those core institutional strengths and that record backlog.
Can you pair it with a short?
And you simultaneously short a high-leverage regional bank that has heavy exposure to revolving consumer credit.
So the thesis is basically a bet on strategic divergence.
Exactly. Goldman is playing offense. They're optimizing for regulatory clarity, investing in growth. The regional bank is stuck on defense, facing margin compression and the political risk of those rate caps.
One is pivoting to profitability and capital return, while the other is just trying to survive the headwinds.
That's the setup. The question for Goldman now isn't if they can hit those mid-teens returns they promised. They've shown they can.
The question is how high the ceiling is.
Right. How high does it go in this new cycle, especially as they start getting those efficiency gains from the one Goldman Sachs 3.0 plan?
So wrapping up this deep dive, what's the one thing that really stands out to you?
For me, it's just a story of focus paying off. They leaned into what they're good at. Record equities, M&A dominance, building a durable wealth business, and it worked.
My takeaway is the challenge of execution on that efficiency promise. The idea of using AI to free up capital is powerful, but they have to pull off that massive reengineering project while still leading in a super competitive market.
It's a big task.
Final provocative thought for you to consider. Given how aggressively they're investing and the massive acceleration we're seeing in global banking and markets, how quickly will the growth difference between that business and their asset and wealth management business change the company's overall revenue mix? It creates a kind of strange problem for them.
The risk that their core business grows too fast.
Exactly. Potentially slowing down that structural shift toward the stable, recurring fee revenues that management says they want for long-term stability. A challenge of being too successful.